On the program, we're talking about the top 5 tax misconceptions. Some of those things that people think that they know about their tax return, and then the reality is it doesn't really work that way. So we're pleased to welcome our fellow certified financial fiduciary, who happens to also be an IRS enrolled agent, Christina Lamb, back to the program. How are you this morning?
Doing good. Thanks for having me, Joel.
Awesome. Good stuff. Well, you deal with this on a regular basis, obviously part of our tax department, and we see a lot of common misconceptions out there, don't we?
Yes, we certainly do. This list was actually created by myself and our fellow CFFs who take incoming calls on a day-to-day basis here at Nelson Financial Planning.
So good stuff. So let's get started. What do we got that's on the list?
So our first item was the graduated tax bracket system. There seems to be a misconception in general about how your taxes are calculated. A lot of people think, oh, I'm in the 12% tax bracket, so everything is taxed at 12%. Well, that is not in fact the case. There is a tiered system starting at 10% and going to 37%, where there's segments of income that each bracket of your income is taxed at. So for example, that first 10% tax bracket is up to $10,000 and change for single filers and $20,000 and change for joint filers. So that first set of income is taxed at a much lower rate. And then if you make over those amounts, so up to $41,000 for single filers and $83,000 and change for joint filers, that portion of your income is taxed at 12%. So as you go through the tiers, each little segment is taxed differently. And the biggest jump, most interestingly, is from the 12% bracket to the 22% bracket, which is a 10% increase, pretty much affecting most of the middle class,
Sure,
I would say.
Because that break, if you will, if we think about the standard deduction, because these are all taxable income numbers that determine which tax bracket you're kind of falling in for that income. Mm-hmm. For married couples, usually about around $100,000.
Yep.
So if you're above that, then you immediately wind up starting to get hit with the 22%. But that's a great example, because a lot of people think that if I get into that bracket, then I just triggered a big problem.
Yeah,
right.
Everything is taxed at that.
And that's certainly not the case. It's not some cliff that if you fall over it, you're going to go straight into the bottom, if you will. It's just the piece that is over that, and that's the piece that becomes important to know sort of how that works, because that leads to a lot of some of the internal analysis that we do at the office in terms of how that plays out for people and what's a good tax efficient decision versus not. And I think you've got a couple of examples of that.
Yeah, so sort of the one kind of leading into what you just discussed was, for example, let's say you're in the 24% tax bracket and you're going to be withdrawing some extra money and also possibly retiring that year. Now, if you take a large withdrawal to, say, pay off for your cars, maybe your house, whatever the case may be, as you're moving into that retirement stage of your life, the year that you're still working, if you take that extra money too, that may bump you up into an even higher tax bracket. So the suggestion would be just wait until the following year once you have retired, and then go ahead and take that redemption. So that would give you possibly an 8 to 10% savings on that redemption tax-wise if you just held off and did a little tax planning and waited a minute to take that redemption.
Right, and look to spread that out over a few years, or
possibly
like
spread
that.
it out. Yes, very true.
Oftentimes we'll run into conversations of folks that maybe they've got their mortgage somewhat paid down to a lower level, and they want to just kind of clean it up and be done with that sort of remaining balance. And that's a great example of where it may make better sense to sort of split it up. Maybe do some now, and then come January of next year, because that's a new tax year, of course, to be able to grab some money at that point to maybe complete what you were trying to ultimately affect. Also, another thing to look at, and this obviously comes up an awful lot in today's world, is the notion of Roth conversions, and do I convert my IRA to a Roth, and how does that ripple through my tax return? Those are that's why it's so important to kind of understand that graduated schedule that we're on, because ultimately then you could be filling up that pretty much all that 22 or into the 24, whereby traditionally you might be at the 12% bracket, if you will.
Oh, exactly. I actually have an example on one of our other misconceptions that goes over just that, in fact.
So then that's certainly one of the biggest misconceptions. I think you were sharing with me earlier. Tax withholding is another one.
Correct.
So
Yes.
what's the big misconception on how tax withholding works?
This is the prepaid plan, which never is really truly prepaid. So when you have tax withholding, whether it be on IRA withdrawals or arbitrary amounts set on pensions, things of that nature, they're generally focused on just that account. So when somebody says, oh, here's your Social Security, it's X amount of dollars, you're like, oh, just withhold 10%. Well, that's just that Social Security portion. As you add up all your different baskets of income for, say, Social Security, pension, maybe IRA accounts, whatever the case may be, all that's going to aggregate to a much larger amount and then fall back to that tier system that we discussed, where the lower amount is 10% to 12%, 22%, and so on. So just because you pick 10% on your Social Security or an IRA withdrawal doesn't mean that tax withholding was sufficient for the withdrawal itself. All that will be rectified when you do your tax return. Now, that portion that you had, the IRS kind of holds, and it goes towards your tax liability, so it's not, forgotten or misused. You still get credit for it. It just may not be sufficient for your tax liability.
And I think one of the biggest areas where we often run into that is when folks sort of take money out of their 401k or whatever that aren't age eligible, and when they dial these 100 lines, and the folks on the other end will typically tell them, oh, you're not old enough, so there's going to be a 10% penalty. And then people say, all right, well, that's fine, just withhold the 10%. But you still owe the tax.
Yeah, that's only the penalty.
The number of times, and I'm sure you've had it numerous times as well, that people are like, oh, hey, I got, they told me that withhold 10% taxes, and then that would cover it. And that only covers the penalty. That doesn't cover the taxes.
Yes,
so
great point.
You really have to kind of understand how all of that ripples through on your tax return, which goes back to point number one, which is understanding the bracket.
Correct.
Because if you're going to take extra money out, that's all going to be at that highest marginal bracket that you are at, not some lower number. So some good points there. What about, I guess, the common misconception? It's funny on this one. I actually was just exchanging some emails with someone about not quite understanding the difference that taxes play on different types of accounts.
Right. So there is a difference between taxation on IRA accounts and non-retirement accounts. So first off, to understand, IRA accounts are pre-tax money, meaning that you have never ever paid taxes on this money. So IRA, 401k, plans like that you have through work, those are all going to fall into that category. And the other type of accounts is non-retirement accounts. Those accounts are after-tax monies, and those monies you've paid taxes on. Let's say you sold your house and you had a chunk of money and you invested that. Those would be after-tax monies. So the difference between these two is IRAs are taxed at ordinary income, and that's fully taxable to you.
Every dollar.
Every single dollar. Every little
itty
bitty penny. Yes.
Right.
And those are taxed at ordinary income, which goes back to that graduated tax scale. Whereas the non-retirement assets are taxed at the capital gains rate, which actually receive special taxation. So there is a tiered system specifically just for the capital gains. So on those type of accounts, you're only paying on the gain because all that money that you put in was after-tax money.
And there's a big difference in terms of the tax rates, income tax rates versus qualified dividends, long-term capital gains. We'll hit that when we come back here on Dollars and Cents. So stay with us through the break. We're talking about some of the biggest tax misconceptions that folks have here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.